class, we will analyze mandatory annual reports by focusing on the income statement. The income statement is also defined as a profit and loss statement, and it has the purpose to show the profit or the loss of the year as the difference between the revenues and all of the costs that have occurred within the company during the last financial year. This document is defined by using an accrual logic, so basically both revenues and incomes are registered by adopting an accrual logic. It is possible to define the income statement adopting two different approaches. The income statement can be reported by nature or by function. The difference is in terms of how operating costs are classified. If the income statement is recognized by nature, we have that all of the operating costs are classified according to their nature. So we will have, for example, raw material costs, labor costs, depreciation costs. So costs are classified depending on the typology. The other way around, if the income statement is defined by function, all of the operating costs are classified according to the organizational unit that is in charge of using this kind of resources. So, for example, we will have a cost of sales, selling, general and administrative expenses. Right now, we are going, and of course, apart from the operating costs, all of the other revenues and costs are then the same. Either we are using the income statement by nature or the income statement by function. So basically the overall profit and the final results is always the same. What changes is represented only by the classification of these costs. We are now focusing on the structure of the income statement by function. So the first element that we have is represented by revenues, and in here we can find revenues which are related to the products that are sold and revenues which are related to rendering services. Then we have the cost of sales. So the cost of sales is represented by the value of all of the resources that are used in order to realize this amount of production. So basically we are just considering the value of resources that are absorbed during the financial year, because remember, we are using an accrual logic. The difference between the revenues and the cost of sale gives rise to what is defined as gross profit. Then once we have the gross profit, it is necessary to add what is defined as other operating incomes minus the selling, general and administrative expenses. Other operating income relates, for example, to other revenues related to rent, related to royalties, for example, which are not specifically related to the production, but still we are talking about operating revenues. Minus what is defined as selling, general and administrative expenses. So we are talking about operating costs which are not specifically related to production. For example, we have advertising costs, administration costs, selling costs, and this difference defines what is defined as operating profit. The operating profit is also known as earning before interest and taxes, but is also defined as net operating income. So all of these three terms can be interchangeable in order to define the operating profit. So this is the profit which results from the operating activity of the company of selling products and purchasing resources for realizing these products. Then we need to consider the difference between financial expenses and incomes. In here, we are considering all of the expenses and the incomes which are related to the financial activities. For example, if we think of financial expenses, we can find the interest on the bank debt. While if we think about financial incomes, we can find the incomes from investments in other companies or the incomes from shares in associates or something similar. So everything in terms of revenues and costs which are related to the financial activity of the company. From the operating profit, deducting financial expenses and adding financial incomes, we can find the profit before taxes, so the result of the activity of the company which is determined before the calculation of the taxes. Right now, we need to deduct the taxes, again, the accrual taxes of the year, and we can find what is defined as profit from the year from continuing operation. Why we are talking about continuing operation? Because all of these revenues and costs are related to the traditional and normal activity of the company. We can have instead some other activities, some other revenues and expenses which are defined as discontinued operation. We are talking about, for example, something which is extraordinary with respect to the normal cycle of the company. For example, the selling of a branch of a company or the acquisition of a new business. All of the revenues and costs which are related to this unusual activity with respect to the traditional activity of the company of selling product and purchasing components enters this discontinued operation. And finally, if we again sum and deduct these results, we can find the net profit of the year, which is the final profit of the company as the overall difference between the revenues and the costs. If we look at the structure of the income statement, we can clearly identify the contribution of the different activities within a company. Specifically, if we look at this structure, we have that all of these data are related to the operating activity of the company. This means that we are considering revenues and costs, which relates to the activity of selling product and purchasing raw material and components for the production. So it is everything which is related to the production process and the operating activity. If we look at these financial expenses and financial incomes, we can find the contribution of the financial activity of the company in terms of revenues, so incomes, and in terms of expenses. Then we can find the contribution of the fiscal activity of the company. And finally, we can find the contribution of the discontinued activity, so the discontinuing operation. Of course, if we do not have any particular extraordinary activity within the company, we won't have anything in terms of discontinued operation. And if we go back and if we think of the distinction between the income statement by nature and by function, the difference between the two approaches can be identified until the operating profit. From the financial expenses going on, the two structures of the income statement by nature and by functions are the same. So basically, the final result of the income statement is to show this net profit of the year. Moreover, if we have that a company is a listed company, the company should also provide the value of the earning per share. So what happens? In the moment in which we have a listed company, at the end of the income statement, after the net profit, we can identify the so-called earning per share. The idea is to define the value of one share that is delivered to the shareholders. And the earning per share can be calculated by adopting two different formulas, and both of them are shown within the income statement. The first formula considers the earning per share as the base earning per share. What's the formula? How we can calculate the value of one share? It is calculated by considering the profit or the loss of the year minus the preferred dividends, which are the dividends that are delivered to the shareholders that own the preferred shares, divided by the weighted average number of the ordinary shares. So if we divide the profit by the weighted average number of ordinary shares, we can find the unitary value of one share, which represents the amount of money that is delivered to one shareholder because of the ownership of the company. There is also another approach for calculating the earning per share, which still is presented within the income statement, that is defined as diluted earning per share. In this case, the numerator is the same, so still we have the profit or the loss of the year minus the preferred dividends. This value is divided by the weighted average number of the ordinary shares plus the convertible instruments. So as you can see, the difference is in the denominator. What are convertible instruments? Convertible instruments include warrants, they include stock option, they include convertible preferred shares. So we are talking about additional rights of shareholders. And if these people exercise these additional rights, the number of shares that we can find increases. And if the number of shares increases, the unitary value of the share decreases. So assuming, for example, that employees that have the stock option exercise their rights, employees will also have some shares. This means that they have exercised their rights, so we have convertible instruments that have become shares, so that the overall amount of outstanding share is increasing, so that the dilutive earning per share, so the percentage of ownership of the company, decreases. And both of these values are provided within the income statement only if a company is a listed company.